Hi there. You're listening to Market Matters, our market series here on JP Morgan's Making Sense podcast channel. I'm Lee Price from the FICC Market Structure and Liquidity Strategy team. In today's episode, we'll be taking a look at a pivotal component of U.S. fixed income, the public finance market. Within the market structure team, we've been closely following the evolution of the municipal bond market, which has become more sophisticated as it has grown to over $4 trillion in outstanding debt. To help untangle the circumstances behind that growth and highlight key themes going forward, I'll be speaking to my JP Morgan colleagues Annie Marinaro, Head of Public Finance Debt Capital Markets, and Isaac Sine, Managing Director for Public Finance Investment Banking. Our discussion will focus on trends in U.S. infrastructure financing, including drivers of supply growth, issuance structures, investor opportunities, and how these recent financing themes shape the trading landscape. So let's get started. Welcome to the podcast, Annie and Isaac.
Great to be here.
Thanks for having us.
So I may be preaching to the choir here, but it seems like there are a lot of exciting developments taking place in public finance, and I'm not sure it always gets the credit it deserves. From a muni bond trading standpoint, it's been a very active market, with trading volumes reaching $13 billion in average daily volume in June and July. But the growth in issuance has been even more significant, increasing by over 30% year over year. The infrastructure sector is a key contributor to that supply growth for reasons I'd like to touch on today. But before we do, it may be helpful to get a snapshot of the market. Annie, let's start with you here. From a capital markets perspective, can we get a quick overview of the U.S. public finance market and some of the issuance trends you're seeing?
Thanks, Lee. As you mentioned, issuance has been a strong advocate for U.S. public finance. Public finance most traditionally encompasses debt raises for U.S., local, and state governments, infrastructure projects, whether that be roads, bridges, public utilities, sports stadiums, museums, not-for-profit healthcare, universities. The list can go on. If there's a public good component, there's a way for it to have a home in public finance. And over the years, we continue to see the lines blur, see more partnerships and broad interest from the private sector in investing into U.S. infrastructure. Structures are evolving, and the interest in participating in innovative structures continues to surge. From an issuance perspective, we saw some issuers sit on the sidelines last year amid higher rates, higher inflation, and broader volatility in fixed income. For many of these issuers, projects, costs, and complexities have only grown, and the patience to wait to a better market has really waned. So we've seen this most dramatically in not-for-profit healthcare, where issuance is already 2 times what we saw in 2023 on a year-to-date basis. Supply is actually 40% higher this year than the full year of 2023 in that sector. Issuers are becoming increasingly comfortable with accessing the market and are employing various strategies to navigate this type of market, including the use of bridge solutions, short-term products, and short calls. Summer funding opportunities have emerged, including, most interestingly, more uses of tender offers to effect refinancings, which actually added about 1 week of supply last year to the overall calendar. U.S. infrastructure projects, as you mentioned, is a cornerstone of the municipal bond market, which have traditionally been across the entire yield curve and credit spectrum. For high-grade transactions, we regularly see types of issuance ranging from commercial paper to long-term bonds, even going out to 30 or 40 years. A few years ago, in a lower interest rate environment, we even saw issuances out to 100 years, particularly in the higher ed space.
100 years, wow. That's very interesting. Thanks for providing that context, Annie. When you think about some of the themes you've listed, is there anything happening in the market right now that you think is particularly notable?
Well, I think with elections quickly approaching, we're seeing a lot of issuers try to navigate that construct. So we're seeing them accelerate their debt issuance plans, and we've really seen that most actively through weekly issuance. Weekly issuance has actually climbed to $9 billion this year compared to $6.5 billion last year. So the public calendar remains quite strong heading into the fall. Another interesting trend we're seeing is the growing participation in private capital into the public infrastructure space. This isn't just limited to domestic investors. We're seeing a lot of international buyers showing significant interest, and has really created an opportunity to have another avenue for raising capital for many of these infrastructure projects that are essential to growth and overall stability of our country. All these factors really set the stage for strong, significant issuance in the U.S. infrastructure space this year, and the buy-side demand is enthusiastic in meeting those needs.
Okay, great. Thanks, Annie. So at this point, we've kind of set the scene in terms of some of the structures and solutions we'll be discussing in more detail later on. Maybe it makes sense to get some context on the supply dynamics. So we're approaching 3 years since Congress passed the Infrastructure Investment and Jobs Act, a $1.2 trillion funding package for improving and repairing U.S. infrastructure. Isaac, we'll turn to you here. Can you add some context that helps explain this critical need for infrastructure financing in the United States and some of the key elements there?
Happy to. So let's start with what we define as core infrastructure in public finance. This tends to span a broad array of sectors, including things like surface and air transportation, healthcare, higher education, K through 12 education, affordable housing, public utilities, and general governmental services. Each of these sectors all have significant capital needs in the coming years and will drive volumes in the capital markets. So take transportation, for example. Our roads, bridges, and airports all have ongoing needs for upgrades and expansion to replace aging assets, as well as meet growing demand to ensure safety. Schools, universities, hospitals require modern facilities to provide quality education and healthcare services. As an example, the pandemic underscored the importance of having resilient healthcare infrastructure that's capable of handling crisis and ensuring public health in challenging times. Public utilities providing water and electricity are also in critical need for new capital. These systems need to be resilient and capable of meeting future demands. General governmental services, things like public safety and administrative buildings, are also requiring ongoing investment to function effectively and to stay current with the times. Beyond financing new capital, the same issuers will remain active with liability management activities, and this includes things like refinancing, utilizing tenders and exchanges to capture savings, and to meet other strategic goals. These activities are crucial for maintaining financial health and ensuring that revenues and taxpayer dollars are used efficiently.
Okay, understood. And what about something outside of the traditional sector that you're seeing?
Sure. So beyond traditional capital projects that our industry has become accustomed to, energy transition is becoming a major topic and is going to have a significant impact on planning over the next decade. This includes the electrification of transportation, which will affect everything from public transit systems to personal vehicles and the necessary charging infrastructure. Healthcare systems and higher education institutions will also need to consider how they continue to transform given their inherent energy use. And many of them actually own or operate their own utility services. Beyond all that I've touched on so far, the emerging trend of data centers and AI, which are going to have a massive impact in how utilities approach their resource planning. As electrification increases, utilities will need to manage additional load. And this growth will be compounded by the increased need for electricity driven by the explosion of AI and resulting data center development. This is a pretty active topic of discussion at the moment, and it's going to take some time to play out.
Very interesting, kind of this blend of traditional and emerging trends there. And so we've got this significant need to update the country's aging infrastructure as well as fund new projects to improve transportation and accelerate energy transition. And Isaac, you've mentioned that projects are increasing in size and complexity. At the same time, and Annie, you alluded to this, economic and policy factors, so think higher capital, low ratios, lower corporate tax rates, have contributed to the current funding dynamics we're seeing. So despite the urgency, there are clearly some complexities involved in funding these new projects. Isaac, as issuers seek financing strategies to help mitigate the challenges we've mentioned, what are some of the other key themes we're seeing?
So I mentioned earlier that issuers are actively managing their debt portfolios by capturing refunding savings, using tenders and exchanges to enhance or accelerate savings, and just generally being opportunistic with what the market's giving them. But there are several other ongoing trends that play a role in efficiently raising capital for our clients. One prominent example is the use of public-private partnerships, or P3s. And these arrangements allow public entities to leverage private capital and expertise to fund and manage larger infrastructure projects. Years ago, this was discussed as incremental capital that wouldn't have otherwise existed for these projects, but the reality is they're more of a risk transfer mechanism that, when done right, provide an effective finance and public project delivery vehicle. Another significant theme we're observing is the focus on green and sustainable financing. Issuers are increasingly turning to green bonds, social bonds, and sustainability bonds to fund projects that have positive environmental and social impacts. This not only helps address infrastructure needs, but it also aligns with broader sustainability goals and attracts a growing base of ESG-focused investors. We're also seeing a lot in the realm of securitizations and have seen a significant uptick as a tool to provide a AAA cost of funding for projects that historically have been associated with capital spend from catastrophic events or stranded costs at a utility. That trend will likely continue with ongoing extreme weather events and has the potential to expand for regular capital expenditures in states with permissive legislation to fund large mega projects.
Okay, right. And what about policy trends?
Absolutely. Federal and state support also remains crucial. You already hit on the IRA, but beyond that, we're seeing fantastic collaboration between different levels of government to provide grants, low-interest loans, and tax incentives to support infrastructure projects. Programs like the Transportation Infrastructure Finance and Innovation Act, or TIFIA, And the similarly named Water Infrastructure Finance and Innovation Act, or WIFIA, are examples of how government support can help bridge the funding gap and have been highly efficient tools that have been used by our clients for many years.
Thanks, Isaac. So let's pivot slightly and look at how some of these market dynamics are driving shifts in investor preferences and participation. Annie, part of your role involves overseeing JP Morgan's Muni private credit offering. What are some of the characteristics of Muni private markets, and how might infrastructure investors benefit from direct lending solutions?
Great question. So historically, there were two main markets for municipal finance and U.S. infrastructure. There was a public market and a bank market. And I think everyone was pretty happy with that for a long time. But what we found was that there's a gap between those markets. Banks are often focused on shorter tenors and covenants, whereas the public market is very comfortable with duration. So when you think about that gap, how do you create a private market that allows for duration for a lot of these issuer clients? And so that's become very appealing, and we're seeing a surge in that type of issuance, whether it's tax exempt or taxable. This is also across both high grade and high yield. These are different types of investors for different reasons. But at the end of the day, what we've seen is that there's something for everyone when it comes to the need and the interest in doing private credit for our types of clients. In the high grade space, whether it's hard or social infrastructure, the global investor base has been very interested in diversifying their portfolio, extending duration, and for certain investors, they're actually able to qualify for better capital under Solvency II. A lot of these types of high-grade private credit deals involve more structural flexibility. They're comfortable with more lease structures, delayed draws, and there's an added negotiation that creates bespoke structures that better reflect the issuer's interests and needs. Portfolio diversification is really important here. For a lot of those investors who have been very active in private credit for many years, they haven't necessarily had the ability to access this market, and it provides a great way to balance their overall portfolio.
Okay, thanks, Annie. And how does that differ from the high yield market?
In the high yield, we continue to see not just interest from traditional municipal high yield or hedge funds. We're also seeing a lot of infrastructure investors who really haven't done a lot of foray into municipal finance become more involved. A lot of those investors view these types of credits as a way to meet their sustainability objectives or overall infrastructure mandates. And they actually offer a lot more structural flexibility than what might be available through the public high yield markets. Now, a lot of those structures, there's a cost to them, but for some of these projects, that can make all the difference in actually creating a successful project that will last for the long time. It's probably worth chatting about the difference between tax exempt and taxable when it comes to pricing of private credit. What we've seen is that in tax exempt market, the pricing of private credit tends to be highly correlated to public market sentiment. So as your new issue subscription goes up and allocations go down, the interest in private credit and the pricing itself becomes a bit more competitive. Whereas in the taxable market, there's so many global cross currents around interest and the depth of that market that tends to be consistently very strong when it comes to pricing.
Okay, very interesting. Thanks, Annie. So you've mentioned that there's a private market and a bank market. How do you anticipate those interacting going forward?
There's always going to be a need for strong bank balance sheets to invest in issuer clients. That's not going to change. Where I could see things changing is more co-lending opportunities and abilities to partner with our investor clients to get to the right solution for our issuer clients.
Understood. Thanks, Annie. And certainly, private credit investment has grown rapidly for middle market lending, and there are some similarities here, as you mentioned. For the second half of 2024, Federal Reserve rate cut expectations and the upcoming presidential election are also top of mind for market participants. Isaac, as you previously mentioned, the increased use of tender offers for economic savings is a trend. How should investors be thinking about opportunities in the current market environment?
So on the issuer side, we're certainly seeing more interest in short-term products as many are anticipating rate cuts, as you mentioned. And there's also potential for a steepening of the yield curve. But what we typically say to our issuer clients is that they should remain nimble with planning, as you can really make a case for rate movement in either direction on the long end of the yield curve. So most issuers are taking a measured approach with where they issue on the curve and the market that they access. We've hit on the robust bank market, an active capital market, and Annie's points on private capital are increasingly relevant for issuers in our world. The takeaway here is there's an amazing amount of focus on infrastructure investment in the U.S., and that provides us as bankers with a tremendous set of tools to help clients fund projects and meet their strategic goals.
And of course, advancements in technology have also led to innovative solutions in the muni primary markets. In April, the city of Quincy, Massachusetts, issued the first blockchain-based municipal bond offering. This transaction took place on JP Morgan's digital debt service, which is an application that leverages digital ledger technology, or DLT, to facilitate issuance, trading, and settlement of debt securities. In market structure, we've been tracking the development of DLT products and tokenized solutions in financial markets, which so far has largely materialized in repo and clearing markets. Isaac, your team was directly involved in the Quincy issuance. I'm curious to hear your view on the potential of these evolving DLT tools in financial markets. What more can be done to expand the use cases and ultimately establish liquidity?
Yeah, this was a fun one. This financing was issued on our new digital debt service platform, which the tech folks would call a private permission blockchain that's been developed internally by JP Morgan. The Quincy bonds will be managed on this platform throughout their life cycle, and that includes everything from issuance, trade settlement, and servicing coupon and principal payments. So as you mentioned, this spring, Quincy successfully settled their inaugural $10 million financing, received their funds directly into a blockchain deposit account. And this was the first official launch of digital debt service and was the result of a project that took over 3 years of internal collaboration to issue bonds on Onyx digital assets. This is the first time municipal debt has been purchased, settled, held, and managed on a blockchain. At the end of the day, the platform does a few key things over traditional debt issuance. It covers the entire bond lifecycle in one platform. It reduces settlement risk as bonds are exchanged simultaneously with the funds. It decreases reliance on outside parties. It provides real-time visibility into a shared ledger. And it allows programmable settlement, including T+0 and precise settlement times. So it's pretty exciting stuff when you consider how much can be streamlined in the fixed income market. This process marks a significant milestone in integrating blockchain technology into municipal finance and the overall bond market. But to your question, there's still a lot of work to do to establish liquidity for these markets. That will take time as investors onboard to the platform and more issuers are supportive of establishing new avenues to raise capital. But we're really excited about the possibilities for this technology, so I appreciate you asking the question.
Yeah, exciting indeed. I think it'll be fascinating to monitor the further evolution of the DLT-driven products in public finance and in the financial markets in general. I would just add that in the secondary markets, we're also seeing a shift in terms of how market participants are increasingly leveraging technology. So if you think about the growth of electronic trading across asset classes, but also the emerging significance of exchange-traded funds, fixed income ETFs have experienced tremendous growth. Muni ETF assets under management now exceed 14% of the total Muni AUM, according to JP Morgan research. So maybe flying under the radar, but I think the Muni space is definitely in the conversation around developing execution trends. So Annie, turning back to the primary side, where else can we expect to see innovation and growth in the public finance arena?
So I think financing strategies are going to continue to evolve. We've now seen several tax-exempt pooled finance structures come to market as an alternative to traditional financing techniques. These are akin to a municipal CDO, although it has a static asset pool. These structures allow investors to finance a specific pool of assets, sometimes across multiple sectors, while accessing a more attractive portion of the yield curve. Typically, tenors have so far been 3 to 6 years. So really avoiding kind of the ultra short end, which was typically a method of financing these types of assets. The other area we're seeing a ton of innovation is really in the prepaid bond space. So there's been a lot of issuance over the past few years, mostly focused on gas, and we're seeing more in the renewables space. And we'll continue to see innovation as the list of funding recipients who want to be a part of these transactions continue to grow. This started with traditional banks. It's going more into the financial services space, including alternative asset managers and other corporates. These structures can provide a material benefit to these types of funding recipients relative to traditional funding markets. We're also seeing more structure overall, whether it's lease transactions or credit tenant leases, as a way of having municipal credit access, but through structure. As Isaac mentioned before, P3 investment is going to continue, including energy as a service, which continues to develop as the Inflation Reduction Act allows nonprofits and other non-tax-paying entities to benefit from the subsidies that for so long were only really available as tax credits and was really out of reach for those entities.
Fascinating. Thanks, Annie. It sounds like we're all in agreement that the expanse of this market seemingly has something for everyone. We've covered some really interesting topics here today, including infrastructure issuance themes, market growth, product development, and financing vehicles. Such a vast market with a long list of impactful trends in the infrastructure sector. I think it's fair to say that investors and market participants will be closely watching these continued advancements. Annie and Isaac, thanks for joining today.
Appreciate you having us.
Thank you.
To our listeners, stay tuned for more FICC market structure and liquidity strategy content on this podcast channel. Until next time.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.